Now that we've talked a bit about the U.S. stock market and where things sit, and now Powell was asked about GameStop and he declined to comment, and he was saying that regulators are going to look over the next year to look at non-financial sector. So it'll be interesting to see how this all goes. But this was an interesting chart looking at the use of executive orders, and we've seen that increase over time, where each president seems to do more than the previous. And we can see Biden has obviously gone to extremes on that side in terms of how quickly he's been moving forward. And you could say that, well, his victory, he took that as a means of going out and reversing a lot of Trump's orders. And so that's why he's done it so quickly. This is actually old, as more have come out today on climate change and trying to tighten the emissions and making emissions more stringent. So again, there's more executive orders to come. It's a slippery slope, and just one wrong doesn't make two wrongs don't make a right. And the question is, how do we get away from just directives and trying to come up with a more cohesive means of debating and coming up with a longer term solution instead of just throwing these executive orders around? Again, this is just more I think this chart points more to the problems in our political system than it does is a Republican or Democrat right. Neither is right. It's just we need to figure out a way to compromise more and to come up with a solution that is a bit more cohesive. And I think this is just a symptom of a much bigger problem that needs to be addressed. Now, talking about Biden's, what he's looking to do, this is looking at the Fed Treasury purchases, net Treasury supply, and then the Biden proposal in terms of new needs for stimulus. As we talked about last week in segment 2, we kicked off with what that stimulus looked like and how is it going to be financed. So clearly, we're going to have to go out there, issue more debt. We're going to have to bring some more in terms of getting some of this cash into the market. And the Fed Treasury purchase program has been fairly slow in comparison to the net Treasury supply. So there is still demand out there. But when we talk about when is the game over? And if you look at GameStop, when is the game over? The game is over when there's no longer an incremental buyer. So when you generate a short squeeze, the shorts are going to be your incremental buyer. But when the shorts are gone, who is your buyer? And that's why when you're thinking about, well, if the Fed isn't your buyer, international is, at what point are they going to say, no, I won't buy this interest rate. I'll buy this interest rate. And again, that's when we start talking about those rate shocks and those rates moving up instead of down, given where people are willing to borrow. And that's going to be a factor of what is the risk to it, what is the inflation expected, and where is that break even? And I think that's going to be a much bigger component to where things are. And if you consider the ECB cutting rates further, well, does that mean that people are going to want more treasuries? And if they want more treasuries, they're going to rush out and they have to buy dollars to buy treasuries. So again, what the ECB is going to do and what the euro is going to do is going to be very indicative to where the treasuries go and where does the dollar go in the near term. But what are some of those headwinds? Well, let's look at dollar bankruptcies. So here you can see the bankruptcies in general, and not obviously the pie chart's important in terms of who saw the most pain, but I think another big component is the size. So when we look at the share of companies with liabilities above 1 billion, you can see just how elevated everything is versus 2010, 2011, because 2010 was that reverberation through the system, where the size of these bankruptcies are getting bigger and bigger. Because what have we had over the last 10 years? We've had cheap debt. We've had people leveraging balance sheets. So the inherent liabilities on these sheets are massive. So when you go into bankruptcy, what kind of haircut is taken? What kind of pain is being pushed down onto the bondholders? And I think this is going to become a bigger problem, not just the total. Obviously, a lot of companies went bankrupt. We went through a pandemic, so not surprising to see this. It's just we don't see 2021. Obviously, it'll be a little bit slower than 2020, but it won't be that much slower given the rolling of debt and just the size of the balance sheets and these zombie companies that we keep talking about. which again is going to put more pressure on some of these companies that are struggling. And so, but what do we have? We have a lot of liquidity. So what do we have because of that? We have a lot of SPACs. And these are just another really cool chart from the Wall Street Journal that I just thought was a really interesting way of looking at just the growth of SPACs over time, but looking at the IPO date throughout the course of 2020, because you can see how as the money got easier and easier. So think about what happened in March. March when or harking back to segment 1 when we talked about margin call. Well, the people in March, which there were multiple hedge funds, were leveraged long. Now, what happened in March? The market collapsed. So if you're leveraged long, you will also have a margin call. If you cannot make that margin call, the prime broker is insolvent. The same thing happens on the other side. So again, it works both ways. It's just they were way more leveraged long than we have leveraged short right now. So this is a little bit of a difference. But again, you're seeing just what this looks like as more money sloshes around trying to find a home. And you can see that it's almost like a megaphone, where we continue to see more and more SPACs coming in, more blank check components. And this is where, I think it's interesting to look at where is it focused. Technology, healthcare, is a big driver in terms of where this is at, right. Obviously we had energy transition, which will continue to be in there given the executive orders, the Paris Accord, all of these things. So we're going to continue to see a lot of these movements across. I think, personally, it will be technology, energy transition is going to continue to be the biggest size of these bubbles. As you can see, the bubble gets bigger and bigger because there is a lot of money out there and it needs to find a home. But when you think about where is it going to find a home, who is it going to benefit? And I thought this was an interesting, I love the Brookings Institute. I think they do a very good job of parsing the data. And again, I don't have to agree with all of it, but I think they do a very good job of putting it together and then supporting their information. So this is the wage growth in the middle. And again, this is what we keep coming back to on. This isn't something that has been a problem for 2020 or in 2019 or 2018. This is a percent change going back to 1979. Where has the pain been? And we just, again, social immobility has been a systemic problem for much longer than just this decade or the previous decade. We're looking at this problem that has been festering over a long period of time, and that's why to see it coming out on both sides isn't surprising, because there are people that have been feel left behind. These inherent problems and the median wage for each wage quartile restricted to workers ages 25 to 54. Prime age, when you should be seeing your growth going from 25 to 35 to 45, you should be seeing this wage growth, and you're just not seeing it. And that's why when you look at inflation and where inflation has gone, wage growth is going to become a much bigger issue over time, or real wage growth, as we start to see inflation going up, which is why we have to look at, crude prices. Crude prices here, gasoline prices where they are. That is going to be a base effect. You're going to see an increase in inflation. The issues that we'll talk about and continue to show, as we showed in the previous segment, where we had just these increase in the Baltic index that's going to pull inflation higher, as wage growth is going to face new challenges with a tough labor market, with a minimal amount of jobs available. That will become a bigger issue. Now, this is something that we also talked about, and we want to talk about it again, is how is it going to change? It's going to change because less people will be working in the corporate office and working more remote. So if you're working remote, does that mean that I have to pay you the same amount if your headquarters is in New York City, but you're living in North Carolina? So then you might say, okay, well, I can pay that person less and give them a better cost of living. So, quality of life based on their cost of living. So these are going to be things to think about when we're looking at how people adjust where their locations are. And we're going to go deeper on what new businesses are looking at and how they're, looking to structure over the longer term. Now, this is something that I just wanted to pull down because it's important to talk about each piece. So housing starts, again, gangbusters. We'll continue to talk about, building starts and housing starts in general. Philadelphia business came in strong. We'll talk about why was that strong so much, versus expectations versus where it is. Initial jobless claims, there's going to be a snapback event where we think that there was some delays that will start to get caught up. So given it's moving in the right direction, and it'll still be down, versus where it was on January 16th. But again, it's going to be a little bit higher than we think what expectations are. And then when we start to look at PMI, you can see that there was a beat to the upside, but we have to talk about why was there a beat to the upside. Existing home sales, again, can't stop, won't stop. It's just, but then when we start looking at some of the specifics on Chicago National Index, you can see that we had a little bit of a slowdown in Dallas. Chicago's fairly flattish, but mortgage applications are slowing. Durable goods slowed, and we have to talk about not so much the durable goods that have moved across, because durable goods ex transportation was up 0.5, up 0.7 from expected 0.5. The orders is the one that we want to pick up on, because the orders is going to be important for the future. What orders have been placed in December that will get delivered, throughout the next 3, 6, 12 months. And you can see that, the expected durable goods orders was expected to be at 1%. It came in at 0.2. And that's going to be, I think, a bigger factor as we start, piecing apart these different components. Now, digging in a bit to PMI, so here you can see that flash PMI came in at 58, given where it was. The expectation was for the number to be at manufacturing was supposed to be at 56.5, came in at 59. Services was supposed to be at 53.4, came in at 57.5, which averages out to our 58, just to give you an idea of kind of where that backdrop is. And the U.S. manufacturing at 59.1 is a series record high. Good. U.S. manufacturing output index at 60.5, 77-month high, crushing it. So again, these are good things. But meanwhile, there's good parts and bad parts to this. Significant supply chain delays, raw material shortages, and evidence of stockpiling at goods producers pushed input prices up. The rate of cost inflation was the fastest since April 2018, with firms raising output charges at the sharpest pace since July 2008 in an effort to partially pass on higher cost burdens to clients. Greater demand and other monthly rises and backlogs of work led to a quicker increase in employment in January, which is a positive in terms of getting some of that adjustments. The rate of job creation was the sharpest for 2 years and strong overall. Again, that is a positive in terms of getting some of this movement. But again, that's going to take time to filter through the system. However, capacity constraints are biting amid the growth spurt. Not only have the last 2 months seen supply shortages develop at pace not previously seen in the survey's history, but prices have also risen due to the imbalance of supply-demand. Input cost inflation consequently also hit a survey high and exerted further upward pressure on average selling prices for goods and services. Again, prices are going up. They're trying. Now, the company is seeing some ability to pass it through, so the consumer will see some of those cost increases. But now we're starting to see some of the movements in employment. Can we see that move through and see some wage increases? And that's where we're going to continue to see this strife. And that's what we're trying to focus on the most. Well, let's look at output prices. So here's to give you an example of where those output prices are. We're just looking at just how high U.S. manufacturing PMI output prices have gone. Again, this is going to lead to that inflation. This is an expansionary territory, because remember, anything above 50 is expansionary, anything below 50 is contractionary. So you can see just how quickly we've seen that reverse. Now let's look at U.S.-oriented strand board composite prices. Again, everything is shifting up, and that's why we continue to remain concerned when we look at inflation, when we look at what is the pain the actual consumer is realizing at a leading indicator, what is happening right now and what is going to be the issue going forward. Then when we look at Philly, so the Philly numbers were better than expected. And this is part of what was really driving that. Prices paid and prices received. So you can see that on the manufacturing side, they paid, let's call it 45. So they paid 45 prices paid off of this massive low. So they paid 45 and they passed through, let's call it 37. So the manufacturer is still feeling some pain, but they're pushing more and more of that through in terms of what was paid and what was received. This is going, again, to create that inflation impact when we start to look at that year-over-year capacity, that month-over-month, and we try to identify what are the issues at the consumer level and what is going to enable them to maybe not purchase as much. Because when we look at what happened in April, right? So in April, we got extended unemployment benefits, we got a $1,200 check, and we had a huge deflationary issue. So we had deflation kick in. Now you're giving people the same amount of money on an inflationary standpoint. So that money will not go as far as it did previously. And that's, I think, hasn't really been factored in to the level it should be when you're considering what is the consumer going to do and what is their buying power going to be on the other side of receiving this money. So then when we look at, where are some of the other areas of inflation? Well, let's look at existing home sale inventory versus prices. Not surprising to see them going in opposite directions. So this is something that, as we showed in the economic data, is going to continue. We have more permits, we have more construction, but we also have the moratorium on foreclosures, on evictions, which is shrinking that supply that would naturally be coming to the market on a pretty regular basis. So that's taking even more inventory out of the market, pushing those prices ever higher, which are supported by the fact that rates are essentially free. But let's look at what is Case-Shiller saying. So when we look at November S&P CoreLogic Case-Shiller National Home Price Index, 9.5% year over year versus an estimated 8.9%. Phoenix and San Diego reported highest year-over-year gains among the 19 cities surveyed. Again, this is going to impact inflation. This is going to push that core component up. It's going to push those single home rents up. Obviously, the urban side is going to remain on a deflationary trajectory in terms of rent, but just home prices, home rents, that will continue to move higher and will continue to kind of pull that core CPI up. And you can just see the direction and the rapid move that we've seen over a very short period of time. And that's what is putting a bit more pressure on consumer expectations of how would you respond to a 10% increase in income. How much of it would be spent, how much of it would be saved or invested, and how much would you use to pay down debt. So you're seeing more and more people getting a bit more concerned and seeing more of it getting saved. Obviously, people who are watching the market want to invest immediately. So you're seeing, but again, the spend side is naturally going to go up, just given that you may have delayed some of your purchases. So an increase in income would be a benefit. But a lot of people have already kind of paid down debt. You're starting to see that adjust. But again, the save and or invest is. And I think the save side is becoming a bit more of a focal point in terms of when does that money actually see the market. Now, when you're saving, what are you saving for? Well, let's look at, again, these U.S. existing home sales, most since 2006. And these home sales are becoming a bigger component when we look at existing home sales and the different, I thought this was just a pretty chart to kind of highlight just where we sit in relation to the highs of 2003 to 2006 that we're really kind of getting back to it. So are we at the precipice of something bigger? Or is this something where we had a first mover reaction because people still are concerned with their situation, so they're going to save more, and we're going to talk about just consumer confidence in the next segment to look at, well, what is going to happen going forward, and then how are companies looking? Well, I thought this was interesting to look at U.S. advertising spending. So you can see TV continues to trend to the downside as the internet kicks up a significant amount of advertising dollars. Now, hint, hint, wink, wink, if you need a place to advertise, we are happy to take on your advertising dollars and give you some airspace. But again, this is just looking at kind of where that trajectory is, where we think you're going to see more. And I think this is a fair assessment to TV losing some market share. Radio has been fairly stable for a long time, but the conversion is going to be off TV onto internet in terms of where we get some of these new advertising dollars in general. But when we look at just, again, how are you reaching the consumer and how are you generating that traffic? Why go to the internet? Well, when you think about actual traffic, so this is North America Retail Traffic Index. Now, this is looking at people that have sensors on doors. So you can see that there is even after COVID, there is a movement down in terms of the people actually entering the store in general. So how are you going to reach people who are now home more, going to bricks and mortar less, and are looking online more often? Well, you're going to increase advertising dollars to the internet as your retail traffic shifts and you want to try to reach your target consumer. So this is going to be kind of that important movement because, again, while this is obviously at an extreme, we really don't see this getting back to normal as you kind of see how people are changing the way they purchase, their consumer behaviors, which comes back to where does gasoline demand go? Where does diesel demand go as people do less in stores and more online? Again, this is that pivot to how much recovery can we actually see in gasoline demand? And then when we look at, okay, well, where is some of this money coming? Because we've talked about some of these different shifts, some of these movements. Well, building permits are going higher for obvious reasons because they're trying to capture this growing market of this shortfall. But who's going to buy it? Like, you're saving more, you're not spending as much. You've already seen the first movers in that could move have moved. So when you look at U.S. building permits, they're obviously going up, but new home sales are starting to kind of roll over. So, and again, there's a seasonal impact. There's a movement in that. Single family building permits are going up. New home sales have started to normalize, still at highs given what we've shown, but it just means that building permits will also start to roll over a bit. And that's going to kind of look at, well, where are things going to change over the near term in general? And that's when we continue to see housing starts, by region, continuing to crush it to the upside. The Northeast is a little bit weaker as we see, again, that pivot away from the Northeast and into the Midwest, into the South, and into especially the South and the West. And I think the West is going to be an interesting one, especially the Midwest, which we think could get a little bit more activity to the upside. And now that we kind of looked at these different components, now we want to go a little bit deeper into what is happening at the consumer level and what does that mean going forward as we kind of understand, okay, well, we see some benefits on the PMI, on the activity level, on some of the Fed numbers and activity, but where are the jobs? Or are we seeing these jobs actually come through the system? And it's been a bit slower. So we want to tease that out a bit more in the next segment.